Hello and welcome to the Mutual Fund Show. I am your host Neeraj Shah, and in times like these, it's very important to get the right advice to try and understand what should you do with your mutual fund portfolios. Is it time to do some rebalancing? Is it the right approach to think of rebalancing, if at all? If you're putting in fresh money to work, what are the kind of funds that you should put your money to work? Because I'm guessing one thing is a given, that these times don't last forever, and therefore there should not be any change to the investment strategy. If you have, there could be, or maybe there could be minor tweaks to it, but the process of investing, which a lot of Indian investors have gotten into a habit of, which is the systematic investing, should probably just continue. Is that true or no? Let's talk about this with Mrin Agarwal and Rishabh Desai. Both of them join me on the show today. And both of you, thank you so much for taking the time out and being with us, because it's an important day to be doing this show, because portfolios are reeling under pressure. Whether you're a stock market investor or a mutual fund investor, looking at your portfolios today, you must be a bit ruffled about how they are performing. So Mrin, before we talk about the how to rebalance, what should an investor do? Is this a good time to rebalance? Is it a time to sit tight? Or is it a time to continue the investment strategy as earlier, as difficult as it may be?
So good afternoon, Neeraj, and nice to be on the show today.
Thank you.
Well, as such, I think what is really important is to, first of all, build a portfolio that can withstand different market conditions. And, it's very difficult if we have to keep changing our portfolio strategy or even doing the tweaking on a regular basis based on the news that's there in the markets. It's going to be very, very difficult to actually manage a portfolio like this. So I would say, yes, we will talk about a couple of things that you can check at this point. But as such, I think if you have got your asset allocation right, and if your portfolio is as per your asset allocation, then I think you should just sit tight.
Rishabh, what would your view be?
Hi, Neeraj. First of all, thanks so much for having me on the show. It's been quite some time since we last did a show together. Yes, I think I more or less agree with what Mrin had to say. Sticking with one's goal, one's time horizon, and most importantly, knowing your risk appetite and asset allocation is something what we advise our clients to do. I mean, if you have a long-term time horizon, then sticking with your risk appetite and your asset allocation is something what makes sense. So to answer it very simply, sitting tight, sitting put during these volatile times makes more sense. Another thing what we recommend our clients to do is to diversify well. A lot of people concentrate on product selection, category selection. But, it is very important to diversify across different styles if someone is venturing into pure equity, like growth and value and contra. So, that really helps in kind of like mitigating risk. And, I wouldn't say, see, if someone is investing in pure equity, of course, there are going to be double-digit drawdowns. But at least, in different market cycles, different products and different styles will outperform. So it's very important to diversify across different styles as well, Neeraj.
Okay, Rishabh, let's start with you on this then. Is there a change of style that you are prescribing with the markets the way they have behaved in October or the way they behaved in October? So come November, the first few days, should people change their portfolios to a style which according to you might work better? And why is that so?
I think, what we recommend, and this is my personal portfolio as well, Neeraj. See, I invest 50% in growth and 50% in value. Right now, growth can consist of, say, like momentum and like pure value. Momentum and pure growth-oriented strategies. And the value segment can consist of, value style and contra style as well. So I think investing 50% in growth and momentum and 50% in value and contra is something what I personally follow. I really don't need to bother too much about rebalancing too frequently, when markets fall, because see, currently markets have just fallen around 10%, which is very hardly. If you see the mid and small cap space, it's the valuations are still very expensive, right? So I think following a 50% growth and 50% value strategy is something what I would do.
Sorry, one more follow-up. Actually, let me first go to Mrin. Mrin, I heard your opening answer. I'm just trying to understand. Would you do some rebalancing, some fine tweaking, or are you comfortable continuing with what your strategy was, let's say 3 months ago?
Actually, Neeraj, that really depends upon what the investor has done. The issue that we really see today is, as always, trend chasing. And people have taken very high exposure to sector and thematic funds, for example, or they could be overexposure to, for example, mid caps or small caps where valuations are stretched. So the tweaking is going to really depend upon the stance of the investor. As such, I do recommend rebalancing only once a year at the end of the financial year. But at this point, if you are feeling uncomfortable as an investor, the first thing that you need to be asking yourself is that, are you ready for market volatility? Because of 10 to 15% drawdown every year is very normal, firstly. Second thing is that if you are not comfortable with this volatility, then you need to look at your portfolio and you need to have a look as to where you have a exposure that you want to cut down. So is it small cap? Certainly, I would say that if you're holding these sector funds and thematic funds, which has been the largest category that investors have acquired over the last 1.5 years, I think those are the funds that you should certainly look at exiting irrespective of the return. So clearly, it's a question of the investor's stance and whether they have the ability to stick on or not. And that said, investors should also keep in mind that equities are meant for the long term. So a little bit of volatility in the short term is not really going to make a difference as long as you have the ability to remain invested for the long term.
Okay. So, Brin, let's try and understand. Let's assume it's an average investor who's watching us right now with average risk appetite and an average time horizon as well. So let's say the time horizon is not necessarily 1-2 years, but right now we are trying to gauge, or even people who might have shorter term goals, but this show is dedicated to people who have a proper mindset in mind of having to look at or investing with a 5-year, 7-year, 10-year period under an ideal case scenario, right? Should thematic funds be out of the window for the time being? Let me ask pointed questions to try and understand this. Should thematic funds be out of the window, or are there thematic funds which you are happy having?
I never advocate thematic funds. So yes, thematic funds should be out.
Okay. Rishabh, what about you?
I agree with Mrin.
Okay. That's
I really don't see any value addition in sectorial and thematic bets, Neeraj. See, unless and until if someone is investing in a product like Nasdaq 100 or a FANG Plus index, that's very different, because they are taking global exposure over there. And in today's time and age, I think having global exposure is very important. But see, if you see the thematic and the sectorial funds today, I mean, if I diversify well across flexi cap, multi cap, mid cap, and small cap, automatically, sectorial and thematic rotations is going to happen from the fund manager side, right? So I really don't see a lot of, cluttering your portfolio with too many funds. And of course, see, there has been plenty of liquidity over the past 2-3 years. Returns have been phenomenal, and investors are more or less pumping in money looking at to the past returns. So I think, following a consistent methodology, right? See, we are in this business day in and day out. So we can take probably sectorial bets or thematic bets, but a regular investor may not understand, when to invest and when to exit. See, there are two things. One is entering at the right time and exiting at the right time as well. I mean, look at the China market today, right? I mean, it's China is more or less like a theme what someone would want to invest, or look at the media sector. It is still negative today. So I think thematic bets is something what retail investors should completely avoid.
Okay, thematic funds should be avoided. So that's the first one. A lot of people are talking about slightly exotic options, and I'll come to those before I come to normal. So people buying into China ETFs, people buying into global funds or global ETFs as well. Is that an option currently while India is looking so volatile? Rushabh, I'll start with this one with you.
Absolutely. I think global diversification, especially in the US economy, is very important. I mean, if you see, look at the 10-year data, Neeraj. See, 10-year data clearly tells us that Nasdaq 100 has actually outperformed most of the broader Indian indices, which is the Nifty 50, Nifty 500, right? So I think having one foot abroad, especially in the US economy, looking at the giant nature, looking at the consistent returns, looking at the transparency what the US economy have. I mean, there are so many sectors and companies what India has not even seen. I mean, we are still developing, especially in the technology space. Look at Facebook. Look at Alphabet. These are like Apple. These are giant, super giant company with global presence. And let's not forget, how much ever we want to discuss that the dollar is deteriorating, but see, today dollar is a global currency. I will not deny that, and it's going to take a very long time for the dollar to come down the rail or come down from the primary currency, at least at this point of time. So I think having some global exposure, especially in the US economy, is something what I strongly recommend, Neeraj.
Rin, would you concur, and is it only US, or would you look at China ETFs? Would you look at some others?
I would concur with Neeraj. I'm sorry, I would concur with Rishabh. And yes, I think US is a great market. In any case, it makes up a large part of world market capitalization. And as Rishabh pointed out, some great investments out there. So certainly, I would look at some diversification into US markets.
How do you do this, Brin?
I'm sorry, Neeraj?
How would you do this diversification? An average investor wants to know how to take that exposure. What would you say?
I would say look at a S&P 500 ETF or look at the FOF route, either through the international fund, of course, through the mutual funds, not through direct stocks. Because again, if you're going to try and identify stocks directly out there, one is, the whole aspect of what you buy, but more than that, the tax reporting of foreign stocks in India is quite tedious and complicated. So, of course, through international mutual funds.
Okay, and is there, are there specific funds, Brin? I'll come to you, Rushabh, with the same question. Are there specific funds? These need not be an exhaustive list of recommendations, but indicative list of some of the funds that people can look at and study.
I would say the S&P 500 index fund is a good option if you want a more broad-based option. Because again, when you look at NASDAQ or when you look at FANG, it's primarily directed towards technology stocks. So I would say pick up a S&P 500 index that's available. And of course, study the tracking error to know how well the fund is actually optimizing the investment.
Mm-hmm. Rushabh, what about you?
I more or less agree with what Mirin had to say. See, there are two ways to look at this, Neeraj. One is, unfortunately, there is a offshore limit by the RBI. $7 billion US is the MF overall limit, and it's kind of exhausted today. Okay, so maybe there will be many funds which may not take additional lump sum money, maybe SIP, but not lump sum money, especially in S&P 500 or Nasdaq 100. See, what happens is that when investors try to buy ETF, when there is a restriction, the ETFs can also go at a premium because they are traded in the secondary market. So that is also something what investors really need to keep in mind, is that go for either pure index funds or the FOF route. Let the AMC manage that for you, because if you try to buy the ETF, you really need to see at what price the ETF is being traded. You don't want to buy an ETF which is trading at some 4-5% premium, right? It'll not add much value to your portfolio. So I think keep your portfolios very simple, keep your products very simple. It'll be much more easier for you to track and monitor. So I think if someone wants to invest abroad, Nasdaq 100, either in the index fund route or the FOF, or also investors can look at Indian mutual funds with a combination of Indian equities and foreign equities, for example, like Parak Parik Flexi Cap Fund or the SBI Focus Fund, because even Parag Parikh Flexi Cap Fund do still have around 17-18% towards the US economy. And I think around SBI Focus Fund does around somewhere around 9-10%. So I think including these funds which have Indian equities plus US equities should do the job.
Okay. So before we take some queries, I just have one more question. Would you guys advocate bringing in hybrid funds, balance advantage funds at the current juncture, or was the right time when the Nifty, on hindsight of course, or was the right time when the Nifty was at 26,000? I mean, the question to you first.
See, again, we can't time markets. So I would say, again, it really comes down to the investor. If you cannot take volatility that's there in mid caps and small caps, of course, you have the option of investing in large caps through the ETFs, or you have the option of adding in the balance advantage funds as well. Now, balance advantage funds can be added at any time, because the beauty of the balance advantage fund is that it keeps doing the rebalancing between debt and equity based on various quantitative parameters. And ideally, when markets are overvalued, then it tends to reduce the equity allocation. So I think, again, these calls cannot be taken basis volatility in the market or basis news that is coming out. This is a strategy that people have to decide, how much volatility they can take, how much risk they can take, and decide basis that. But yes, it's a good time for you to do that check in case if you're feeling worried about your investments right now.
Okay. And Rishabh, what's your view here?
Neeraj, see, if someone wants to play defensive, right? I think the best way to do is to be more aggressive during market corrections. See, what happens is during market corrections, you are going to accumulate more units, number one. Once you accumulate more units in the future, see, markets, we have seen that, the downfall or the negative periods have been much more lesser than the positive periods in the equity markets, right? So I think once the units have been properly accumulated during bull markets, the returns will be enhanced. And most importantly, once that volatility phase is waved off after a couple of months or maybe a year or two, the future downside will be very well protected during future market correction. So I think number one, if someone is investing in pure equity, I think the best way to play defensive is actually to be more aggressive and invest or pump in more money during market conditions, market corrections. See, if someone wants to go into dynamic asset allocation funds or balance advantage funds, one should be very clear why they are entering in these products. One is that they cannot stomach volatility. That is a good way to go into balance advantage or dynamic asset allocation funds. Number two is that they don't want to time the markets. They don't want to keep on rebalancing from time to time, and they want to leave that to the fund manager to do the job, right? From equity to debt and debt to equity. So once someone has a moderate risk appetite, someone who cannot stomach too much of volatility, and someone who does not want to time and rebalance on a regular basis, I think balance advantage funds and dynamic asset allocation funds are meant for them.
Okay, let's try and get in some queries going. Jitu is the first question is from Jitu. Don't quite know the age, but Jitu is ready to invest 50 lakh rupees into mutual funds with a long-term view. Considering current market conditions, a good time to invest, or should Jitu wait until the US election outcome is over? Well, Jitu, it's just a couple of days out, but he needs guidance on timing and strategy. Mrin, you want to help?
So as I said, you can't time markets. First thing to keep in mind that long-term view means that you should be in it for at least 7 to 10 years. So that's my definition of long-term. Secondly, in terms of strategy, well, again, it depends upon how much risk you want to take. But I'm presuming that you're looking only at equity mutual funds right now. I always suggest that take a combination of index, like a Nifty 50 index fund, a flexi cap fund, a mid cap fund, and a small cap fund, because in this, you're getting exposure across the different market cap segments, as well as some amount of international exposure. Of course, provided you choose funds like Parag Parikh, which have international exposure. But I think one of each of these categories is honestly good enough. In the portfolio, it will give you large cap, mid cap, small cap, and international exposure. And always remember that it's very important to be diversified among fund houses as well. So don't choose all funds from one fund house, among market caps, and at the same time, remain invested in this for the long term. That is what is really important.
Okay. Rishabh, is your advice different?
I think, investing around 50-60% into flexi cap and the rest can be divided into mid and small caps. This is something what I would recommend, because it gives a good blend of both these spaces, which is the large cap space and the mid and small cap space as well. So I think, first of all, staggering investments is something what I would recommend, because we don't know where the markets are going. I mean, the earnings have also been quite flat on a year-on-year basis. So I think we may see some kind of stagnation, or the correction could continue for some more time. So I think don't just look at the US elections. It's a combination of everything, which is the global picture and plus the domestic earnings of how they are panning out to be at this point of time. So I think staggering investments over the next probably 3 months or so, this is something what I would recommend. So 50-60% into flexi caps, and the rest can be divided into mid and small caps.
Okay. Second query is from Aman Mehta. Aman is 33 years of age. He says I invest 1.24 lakhs a month. Interesting number. 1.24 lakhs a month through an SIP route, and is looking for long-term wealth creation, ideally a CAGR of 15%. Is requesting a review of the portfolio. The goal, Mrin and Rishabh, is a 15% CAGR, as I said, and the portfolio has PPFAS flexi cap, which is about 31,000 rupees a month, SBI Contra 31,000, HDFC mid cap 31,000, and Tata small cap 31,000. So those are the 4 funds, 31,000 each, 1,24,000. Is this a good portfolio, or does it need some changes? Rishabh, I'll start with you on this.
Neeraj, I think overall it's a brilliant portfolio, a good blend of growth and value. It's not too cluttered. Perfectly what I had actually thought, Parag Parikh Flexi Cap and SBI Contra are like Flexi Cap strategies, and one mid cap and one small cap. I think just one change I would like him to make is the HDFC mid cap opportunities fund is a giant fund today. It's around more than 60,000 crore fund. So I think the AUM, especially in the mid cap space, can hinder the future performance. So I think I'm not telling him to redeem from HDFC midcap. I'm just telling him to stop the SIP in HDFC midcap and start an SIP in a moderate AUM midcap fund. So probably I would suggest him, instead of HDFC midcap, I would suggest him to go for an Edelweiss midcap fund. I think that's the only change I would recommend. Otherwise, the portfolio looks perfect to me.
Okay, portfolio looks perfect. And Mrin, very quickly, your advice before we move on to the next query.
So I concur with Rishabh that the portfolio is fine. I think somewhere he needs to possibly look at moderating his the returns expectation. I do see a lot of investors who think, SIP, if I do, I'll get 15%. So I think it's better if you have slightly lower returns, lower return expectation of, let's say, 10 to 12% over, having this goal. It's nice to have a goal of 15%, but yeah, that's the only point that I'd like to make.
Okay. The next query, Mrin, is from Abhrajit Das, age 22 years, wish to start investing 10,000 rupees a month into SIPs with a 10% annual step up, horizon of 20 years. Can you suggest some funds?
Well, firstly, I'm happy to see that he's having this step up plan in place, because one of the key things which I advise on is to focus on the corpus, because we are assuming average returns of 10 to 12%. So then a good way to actually build corpus is the actual annual step up, right? In terms of funds, given his age being 22 and the fact that he has an investment horizon of 20 years, I would say take some good risk, take higher risk and look at mid caps and small caps. So maybe like Mire mid cap, SBI small cap. These are a couple of funds that I would suggest.
Okay. Very quickly, I'll try and take one more query, and Rushabh will have to make this quick. But Rajesh Choudhary, age 36 years, is investing 90,000 a month through SIPs across 10 funds. 24-year time horizon, expectation of 14% CAGR. Please review the portfolio. Rushabh will have to make this quick. The goal, as I said, 14%. The funds on your screen. PPFS FlexiCap 10,000, Mira Asset Consumer 10,000, HDFC Midcap, about 10,000 in HDFC Manufacturing, about 5,000 coupled with the HDFC Pharma, Nippon India Growth, Nippon Multicap, HDFC AMC, Nifty B. So about 9 funds.
So there are two things, Neeraj. One is there are too many funds, which I would recommend to trim down. Number two is that he's concentrating on certain AMCs, which is HDFC and Nippon. I think diversifying across different AMCs and different products is something what I would recommend. I'm not a very big fan of the sectorial and thematic funds. So manufacturing, pharma, consumer. I think these are the funds I would like him to kick it out from his portfolio. Stick with 4 or maximum 5 funds. I don't think there should be more than five funds in one's portfolio, in one's core portfolio, especially on the equity side. So probably stick with FlexiCap fund. Introduce one more FlexiCap fund, like probably say Franklin India FlexiCap fund. He can stick with Nippon India Growth Fund, and I would encourage him to introduce one more small cap fund, probably say like Kotak Small Cap Fund. But just stick with 4 or 5 funds, 2 or 3 FlexiCap, 1 mid cap, and 1 small cap, Neeraj.
Got it. Okay, both of you. That's all the time that we have on the show. Thanks so much for taking the time and being with us and giving us your advice. Really appreciate your time. That's all the time that we have on this leg of the Mutual Fund Show. Stay tuned to NDTV Profit.